now you've got a business. You like the economics of the business. You don't hate the management. They haven't done anything horribly stupid, so you move on. You want to value the company. And my first piece of advice when you're valuing a business is try to avoid looking at the price. Try to avoid reading anything about the valuation for it. It's easy to get biased, and you don't want to be anchored to a number before you do your work. And the easiest way to avoid being anchored to a number is to have no idea what that number is. This is particularly easy with spin-offs because there is no number. But in other cases, like, try to avoid looking at it. You can always look at it later. It's still going to be there. But don't do it. So that's my broad piece of advice on valuing. What I do on valuing is I look out the next 3 to 5 years. I say, what do I think is reasonable for this business? How do revenues grow? How do profits grow? What is the capital invested in this business? What does the balance sheet look like in terms of debt and maybe excess cash? And run that out the next 3 to 5 years. How does it grow? What does the business earn? Where do those earnings go? Are they buying back stock? At what multiple? What happens to the share count? Are they making acquisitions? What is the return on those acquisitions? What earnings now flow into the company as a result of those acquisitions? Or am I getting dividends, which is pretty easy to calculate? So then I'll have my reasonable case. This is what the next 3 to 5 years looks like. The next thing I do is I say, well, what's the downside? What if I'm wrong? What if it doesn't improve the way I thought it was going to improve? What if that competitor that I wasn't so worried about is actually maybe a little bit more of a threat? Put those numbers in. So you've got, or maybe it's a recession. Like you put those numbers in. Interest rates go up. You can do a lot of stuff. Put those numbers in. You've got revenues, earnings, capital, and the cash flow that comes out to you and what that's worth. So now you've got a reasonable case. You've got a downside case. Before I value those, I want to look at M&A multiples to sanity check my reasonable valuation for this company. So go out there. What did real people put real money on for businesses in this industry or for similar businesses? And you don't follow this slavishly. Like, you don't have to listen to these people. They get stuff wrong like everybody else. But use it as a second opinion on your reasonable ideas. Like, what were other people doing? So now I value the business, and I've got the sanity check that I can use from M&A multiples. On the downside, to try to be conservative, I take the net present value of the next 3 years. What is that worth? So I'm putting a multiple on 3 years out. Any dividends that I'm getting along the way, that's my downside, is the NPV of that. My reasonable case value is over the next 3 years, what do I earn in this, not in a huge gray upside world, but in just like the world as I think it's going to turn out. And so I've got that value, and I've got the downside value. Check with the M&A multiples. Is that reasonable value reasonable according to the universe, or are you way off the reservation? I take those two numbers. I've got my reasonable value. I got my downside value. Because I want a good price, a great price, I want to have a great upside to downside ratio. So for me, I want to have a 5-to-1 upside to downside ratio. So I'm going to buy the stock down here, where for every dollar that I would lose if we get to the downside, I can make $5 if we get to the reasonable case. And the reason I do this is because I don't know what the future is going to look like. I can do my work, and I can make my best guesses at it of, like, it's probably going to be like this, but it might be like this. And now I want to have good odds, since I don't know the probabilities, of success. And if I've got a 5-to-1 upside to downside ratio, if fewer than 1 out of 6 times in the future we go to the downside, I'm going to win. And the more times I run this process over my career, the more likely I am to succeed. Sometimes you are going to get the downside, or maybe even worse. That is the game. That is the nature of an unknowable future. But you want to come in with better odds. And for me, a 5-to-1 upside to downside ratio using these sort of mechanisms gives me those better odds.